equity, mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to Equity Mates Investing, the podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a massive welcome. My name is Bryce, and today we've got the first Ask an Advisor for 2024. These episodes are where we bring in the best financial advisors in Australia to give you the opportunity to ask your money and investing questions. To chat through it, as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. I'm excited for this episode. We are diving deep on one particular area of our financial lives. I would say an underappreciated, underconsidered area of our financial lives, especially for you.
Yes.
But we'll get to that.
Yeah.
We're talking all things insurance.
We are talking all things insurance, and we've brought in the insurance specialist. It is our pleasure to welcome Phil Thompson, Director of Skye Wealth. Phil, welcome.
Thanks for having me, guys.
Now, we haven't done a lot of insurance on the show before. We have a bunch of questions that have come in from the community. But before we do, we must do our disclaimer.
This is not financial advice.
We're both just watching Phil's face.
Yeah, the first time we've done that with an expert in the room.
I was actually thinking, when are you guys going to start singing it yourself?
That's what I was saying. I've started singing
in
at
the
home.
shower a lot. Yeah. We're big Stings guys this year. That's our big thing. But we should say, yes, this is not financial advice. Whilst we are licensed, we're not aware of your personal financial circumstances. Anything you hear, any advice you hear is general advice. All this content is for education and entertainment purposes only. We need to get all of that in a sting next time.
Now, Phil, because we haven't addressed insurance in detail before, we've split the questions that have come through from the community in sort of two parts. The first is to kind of set the scene and really understand what life insurance is all about. And then we've got a bunch of just general ones. And as Ren said at the top, I'm in a position at the moment where I'm actively trying to sort my insurance situation out. So I'm sure I'll have plenty of questions, and even off air, we know that there's a lot to unpack. So let's get straight into it. This question has come through. I'm 21 and have absolutely no knowledge regarding insurance. Where do I start?
Well, great question, and most of Australians don't. So we'll just set the scene. When people talk about insurance, there's kind of two main categories. Like general insurance is car insurance, home and contents. That's not what we're going to talk about. We're going to talk about personal insurance. So, and that's under the life insurance banner. And so we're talking about really four main policies. So life insurance or death cover. So that's paid out if you pass away. Then there's a lump sum that's paid out. The second one is total and permanent disablement, or TPD, and that is a lump sum payment if you can never work again. So you've got to be severely disabled to get paid out. The third one is income protection. So that'll pay you a percentage of your income if you can't work for either a short period of time or a long period of time. You will get paid a monthly salary. And then the last one is trauma insurance, or critical illness is another term that insurers use. And that's for serious medical events. So the majority of claims is for cancer, but there's, under different contracts, there's different things like heart attacks, if you've got severe MS or Parkinson's. So there's 30 odd conditions that'll pay out under that critical illness payment. So they're the four main policies that we're talking about. So great question. Most people don't know what personal insurance is either.
It's something that I feel like, I definitely don't have cover in any of those, and we'll get to that in a moment. But where do most people under-insure themselves when it comes to those policies?
Yeah, it's a good question. My belief is income protection is the most underinsured. Most super funds will set up some life insurance or some disability cover or TPD cover for you. Super funds, they've actually got a legal obligation to make sure they're considering it for their members. So that's why most Australians will think, my super's covering it. Income protection is the one that, if you don't have your income, we can have it as amazing wealth creation goals as we want, but if we don't have an income, we can't achieve any of those wealth creation goals. So that's where people underestimate their insurance needs.
So I think that super question is a relevant one. It's certainly the one that I had coming into this, which is first of all, what is in super and what isn't in super. And I had a look at my super policy before you came in this morning, and I saw that I have two super insurance policies. I thought I had 3, so always good to check.
Yeah.
And then I guess, how should Australians think about what insurance is in their super? Is it enough? And then what they should be doing outside their super?
Yeah, so super can only pay for 3 of those 4 policies that I touched on. So critical illness and trauma, legally, superannuation funds can't set it up. They can't pay for it on your behalf. But life insurance, disability and income protection can be owned through the super fund. And when we talk about owning through the super fund, it means the super fund will set it up on your behalf and will pay the premiums from your superannuation assets. They're not doing it out of the kindness of their own hearts. And so, yeah, they can set it up. Whether they do or not, you may join a super fund and they may not have insurance. You may move to the super fund, and if there are a whole bunch of requirements where they don't have to set it up, if you're under 25, for instance, they won't automatically set up the cover for you. So those 3 policies are the ones that will be set up through super.
So I guess the question is, for those 3, should people be taking what's available in their super or doing it outside of super or doing a bit of both? Like, how do you start that? And obviously, it's going to be personal for everyone, but like, how do we even think through that question?
Yeah, so the good thing about having it through super, and you can always increase it through your super, is this.
Well, you say that, but I tried to check and I couldn't do anything earlier. Anyway, we'll have that conversation offline.
I actually looked at the super fund that you're with, and you've got to go through a manual process. It's not like click a few buttons and you can just automatically increase it.
That instantly vetoes my... Yeah, okay. Anyway.
Because the great thing about having insurance through super is it'll get set up on a default basis. So they'll automatically give you cover. And as long as there's no terms and conditions that will veto a claim, which there can be, then you can get paid out. Now, as soon as you go and increase the cover, that's when they will go through what's called underwriting. So they'll ask you a heap of questions about your health history, your work situation, your family history, and that's when they'll determine, okay, maybe we don't want to offer you cover, or yeah, we'll offer you cover at this higher premium.
How do you know that the default is enough? You sign up to a super fund. Most people, when they sign up, don't even kind of pay too much attention to the super product, let alone the insurance that's involved in that. So how does the super fund just lump you in with a default product, and how do you know that that's actually what you need?
I can almost guarantee it's nowhere near enough for almost every Australian listening, because the super funds, they've just got a formula. If you're this age, we'll give you this much cover. And because it's automatically accepted, so the insurance company don't want to give $1 million worth of cover for everyone automatically, because then it's gonna cost a lot and they're gonna have to pay out that much claim without going through that medical underwriting. So they want to have a mechanism where there is some cover available, but super funds and insurance companies will kind of make that default level of cover really small. So if they do offer default income protection, most of the time it'll only last for 2 years, while you can get cover through the super fund or externally that lasts till age 65. So,
oh, wow.
So almost every super fund, when you look at the average mortgage in Australia, and then you look at the average, the default level of cover through, the biggest super fund in Australia is Australian Super. I think they cap out at like $148,000 for life and TBD. And if we kind of go back to just paying off the mortgage, that won't cover almost anything.
Wow. So then you're faced with a decision to, as you said, actually then go through the process through the super fund to, I guess, get them to actually underwrite it properly, or go externally.
Yeah. So there's really 3 ways that you can go and decide to get extra cover or to increase your cover. So you can go through the super fund. Now, the benefit of that is it's paid via the super fund. The downside is the super fund will only contract to one insurance company. So if that insurance company is expensive or they won't offer you cover, then you don't have any options to go anywhere else. Whatever that insurance provider says is the lay of the land in that environment. The second environment is going through a financial advisor, which of course I'm going to say is the best way. And we can talk about, the pros and cons of all of that. And the benefit of that is we can select any insurance provider and we can set it up so your super fund can fund that premium still.
Interesting.
Yeah, so it really doesn't matter if you're with Superhero or Australian Super or Host Plus or wherever you are. Australian Super is an easy one because they're the biggest. So Australian Super, their insurance provider is TAL.
Okay.
Now we, as advisors, we can set up through TAL, external to Australian Super, or we can go with anyone else. Zurich, AIA, MLC, and we can still get Australian Super to fund that policy. And the biggest benefit, and the reason why I would recommend most people go through a financial advisor to set it up, is because if you want to move from Australian Super to anywhere else, Host Plus,
Your insurance stays.
you can get the new super fund to pay those premiums.
Yeah.
And so you don't need to reset up insurance or get your insurance to lapse.
Oh, nice. This is tick number 1 for me because I've always thought it's such a great benefit to have it in the super fund like Ren does, because from a cash flow point of view on my budget, it doesn't, like, it's not seen. You know what I mean? I'm not factoring it in like I am general insurances.
Yeah.
So now knowing that I can go out through someone like yourself and plug in an insurer to my super fund, that actually makes a whole lot of sense.
Yeah. And technically how they do it, the insurance company, they set up a super fund on your behalf. Like you become a member of their kind of shell super fund. And then your super fund will just pay the premiums every 12 months. So it's a rollover to that insurance company's super fund just to pay the premiums. Now, they will never manage your money. They don't want to invest your money on your behalf. It's just a shell super fund just to get premiums from wherever. So that's why if you're with Australian Super, well, we can pay it to the insurance provider, move to Host Plus, then we just sign a new form to say, hey, roll the money over to the insurance provider again.
Wow.
Now, when we were talking about this beforehand, we were trying to figure out the benefits and the costs of paying through your super fund and paying personally, because some of these forms, and correct me if I'm wrong, some of these forms of insurance are tax deductible if it's income protection. Is that right?
Exactly. Income protection is tax deductible.
So is it better to do it through your super fund, or is it better to get the tax deduction?
Yeah, I mean, it's really a personal choice. So, I mean, of course it is. But the reason why I say a personal choice, the way we think about it is if your income is over, a certain level where you're paying a high marginal tax rate and you've got the cash flow permitting, then you can pay it outside of super. And it's a good way to do it. The reason why you can still pay it inside of super, even if you're at the high marginal tax rate, if you do have some superannuation contributions available, now I've used a whole bunch of technical terms here, but if you are not at your cap, then contributing to super to pay those premiums will give you the same net tax benefit.
Okay. Yeah. That makes sense.
So it's only when you're maxing out your contributions year on year, and then your premiums will be impacting the amount that you're investing in that fund. But then again, if you set it up through a financial advisor, what we do in that scenario is we can do what's called a cancel and replace. So we can set it up inside the super initially, run it for 10 years, and then you get to a point where you're starting to max out. We can still keep that contract and just we do a cancel and replace and hold it outside. So we just change the ownership structure.
Okay.
But you can only do that through an advisor. Super funds, they just don't have a mechanism to allow you to pay outside because they're not managing that.
Yeah. That's interesting. All right. Well, I never really considered going to an advisor, but I'm starting to see the benefits.
Yeah, me too.
That's why you ask
So
an advisor.
just to be clear on that point
give
as
you a
well.
sales pitch.
To be clear on the point of setting it up outside but getting the super fund to pay it, you still need to contribute to the super fund for it to be paid, or it just draws it out of the balance?
It just draws it out of the balance.
Okay,
Yeah. So
okay.
if you're on parental leave, then the balance of the fund will be funding it. So you don't actually need to contribute to your super to keep paying it.
But
and
you can.
That's the beauty of doing it this way, because people are buying their first homes and cash flow's tight. So I want my super fund to pay for it. But long term, we don't want this super balance just eaten away by the insurance premium. So setting it up this way, you can go year 1, 2, 3, I'm not contributing to my super fund to cover this cost. And then year 4, 5, 6, you can contribute twice as much.
Yeah.
Again, as assuming you got caps to then make up for that lost payment in the past.
Gotcha.
But if you're paying it all outside of super, you either pay your premiums or you don't. And you have insurance or you don't.
Yeah.
Can you get your insurance company, if you set it up through an advisor, can you get them to also pay the trauma cover through your super?
No.
Okay,
No.
so that's just like a no for super.
Yeah, exactly.
Why? What policy reason? Like,
It's not the policy, it's superannuation law.
no, that's what I mean. Sorry, like government policy reason. Are they?
Okay, here we go. Let's geek out a bit. I like it. So the reason being because superannuation is kind of an environment that the government don't want us to be able to easily pull money out of.
Oh, okay, yeah.
And so
people are getting sick before, and
so you need to get money out of super. It needs to meet a condition of release.
Yeah.
And so a condition of release is death, total and permanent disablement, and temporary disablement. You can get an income protection, but often those policies are a bit watered down. And the reason they're watered down is because it needs to, legally speaking, a super fund cannot sell a contract that's paid through the super fund that doesn't meet the condition of release.
Yeah, okay.
So there are some like really fun catches whereby if you're not working at the time that you are injured or ill, you could have the most amazing TBD policy and the most amazing income protection policy through your super. They just won't pay, that you won't get paid a claim.
Right.
Because you've got to be gainfully employed to meet the condition of release. So that's why sometimes, advisors will talk about the policies inside super are not as good. And those things are so unlikely to happen, but they can happen.
Yeah, but that's the point of insurance, protecting you for unlikely
Correct.
catastrophic events.
Yeah.
Well, look, on that incredibly wonky note, let's take a break. And then on the other side, let's ask some more questions from the Equity Mates community about, I guess, the different types of super and how we should start thinking about it.
Welcome back to Equity Mates Investing. We're here with Phil Thompson, Director of Skye Wealth for Ask an Advisor, talking all things insurance. Now, Phil, before we get into the nitty-gritty questions from the community, one thing that we often hear when we're talking about superannuation funds is to look at the fees and also what you're paying towards insurance and to switch off, insurance if it isn't suitable for you. And I guess the question is, at what stages of life should you be considering the different types of life insurances so that when we're making that decision in super, we're kind of clear on actually I should be having this one on?
Yeah, so my view is income protection. If you've got an income and you rely on that income, you should have income protection. Like, I don't care how young you are. Okay, if I'm injured, I can go back to the parents. Like, who wants to live back at their parents? I did that with my wife and my kids. It wasn't very fun. And so that's kind of a must-have in my mind if you have an income and you rely on it. Disability, it's less likely to happen. It's very statistically really unlikely to happen, but it's catastrophic if it does happen. Again, if you rely on your income, it's important to have a TPD benefit. Life insurance is really the only insurance policy in my mind that we can kind of take it or leave it in certain life events.
Right.
And I'm talking younger people. When you get older and you're 5 years away from retirement, but you could retire today and you choose not to, well, income protection is not as important. But for young people, those income protection and disability is super important. Life insurance, it's just a matter of going, well, if I don't have anyone reliant on me or dependent on me, so I don't need a life insurance portion, maybe you could switch that off. But for young clients, it's so cheap anyway, and it's often paired with disability. So a lot of super funds won't let you switch off the life insurance and have what's called standalone disability cover.
So on that point of no dependents, one question we got from the community was no mortgage, no children. What is the minimum life insurance needed? And I guess you're saying
Nothing.
Zero.
Yeah, I mean,
That's an easy answer.
if you're dead, everyone's going to be crying and emotional if you pass away. But
No mortgage, no
very
kids.
pragmatic and financially speaking, if you pass away and it's not going to have negative financial impact outside of a funeral, then you don't really need life insurance.
Another question that we got that you might be able to tick off quickly. What are the benefits of having both income protection and permanent disability? I think implied in that question is that they overlap.
Yeah, so they do overlap a bit. Income protection won't fully replace your income. So it replaces a percentage of your income. So 70% of your pre-tax income is normal policy. So the idea of when you don't need it, can you live off 70% of your income if you're totally and permanently disabled? If the answer is yes, okay, maybe it's not that important. Our house view at Skye is we like to replace your income because we want your kind of financial trajectory to be the same, whether you're fully disabled or not.
Is insurance are insurance payouts taxed?
Yeah, it's
Because
not that complicated, but income protection is taxable just like normal
okay. Because
income.
I was going to say otherwise, if it wasn't taxable, then
Yeah,
70% makes sense. It's
You'd be
the
the same. Yeah,
But no,
so
that makes sense.
a lot of
Yeah,
people
yeah.
look at their monthly benefit on income protection and they go, well, that's more than what's hitting my bank account, so I'll be fine. But you got to basically run it through a tax
Right,
calculator
okay.
to work out what's your post-tax income protection.
Can you over-insure yourself so you get like
So you get more.
fully covered rather than 70%? Like, I mean, car insurance, house insurance, you can kind of plug in
Nah,
whatever number
Like
you
if
answer-
want.
the
I want
answer is
$1
no.
million a year, and I'll just pay. I can cop the premium.
Yeah.
No,
No?
the answer is no. Income protection.
Have you tried it?
Caps it. I mean, the payment is based on your pre-disability income, and so it's capped at 70% of your pre-disability income.
Okay.
So you can't gain, you basically can't game the system. I'm sure you can, commit insurance fraud if you choose to.
Okay, let's not go down that path.
So let's not go down there. But that's why TBD is important.
Yeah.
So coming back to the original point, that's why we do like to have TBDs, because someone's always going to be worse off on income protection.
Okay.
And so TBD just covers that 30% gap,
Yeah.
because TBD is I can never go back to work.
Yeah.
And so with income insurance then, is the only thing that goes into the looking at the premium just your pay slip? As in, like, they're just like, your income's this, we're going to insure you up to 70%.
So you can't insure like investment income.
Yeah,
And
like-
investment income doesn't offset the income protection payment as well. So yeah, it's just your personal exertion income.
That's
that you
it.
cover.
And so there's no, like, we wouldn't pay a higher premium because we're self-employed.
Nah.
Right. Okay. So it's just, flat.
Yeah, whether you're full-time or you're self-employed, it doesn't have an impact on premiums. It has an impact on what they will cover. So being self-employed, you've got profits in the business that you can cover. So, whatever your salary is and there's profit in the business, and assuming it's 50-50 ownership, you can cover that as well, because if you weren't able to work, there's the assumption that there would be a loss of
Right.
that as well. So self-employed is a little bit more complicated in setting up the cover and a little bit more complicated in claiming on the cover, but it doesn't have an impact on premiums.
Yeah. Right.
So we've got a couple more questions from the community. One that has come in: can you have more than one income protection and life insurance policy?
Yeah, so life insurance is easy. You can have multiple. They will, when you set up a new life insurance policy, they always want to know what else you've got. So if you're rolling in, $1 million 10 times over, you won't be able to get the last 5 policies, because the insurer will say, do you have any other life insurance? And you say, yeah, I've got 5 million elsewhere. They'll say, well, we're not going to offer you that cover.
Oh.
So, but if that's unlikely to ever happen, having that much. But if you have 2 $1 million policies, as long as they'll pay out for that.
And so you can do one in super, one out of super. if you
Correct.
want to.
Yeah. And we do that a lot at our work, because as much as we don't love the super policies, there is a lot of reasons why you should keep that for health reasons, because there may be you may have a health event that can't be insured. So we want to keep that default, that 250K or whatever.
Yeah.
Let's keep that, because it'll pay out on mental health or whatever the new policy will exclude.
Okay.
But income protection, you can, if you have 3 policies at 70% of your income, they won't all pay out. They'll basically,
What if you have 2?
if you got 2, one will pay out and the other one won't.
Okay, I was wondering why you said 3.
Three.
Yeah. Okay.
Sorry. Why would you want multiple life insurance just so you get paid out more?
No, you don't need. There's not really a requirement for it.
No, I know,
You
but
wouldn't
in the event someone's like, I
necessarily
want 5.
do it. We would sometimes get someone to keep their life insurance where it is and then set up a new one elsewhere. That could be a reasonable recommendation for us. But ideally, you just want it all in one company.
Yeah.
So, Phil, I think we've covered the life insurance policies to a pretty good degree. Let's see if I can remember them. Trauma, TPD, life, and income.
Well done.
I'm learning.
Yeah.
And we're going to have you back on the show a couple of times throughout the year. So if people do have more questions, they can ask in the Facebook discussion group or at equitymates.com/contact, and we'll put them to Phil. Otherwise, you can book a session with Phil and get some personal advice about your insurance situations. You can go to equitymates.com/advice.
Which I will be doing.
Yeah, I'm pretty interested in it as well, to be honest.
We'll talk about it on the next episode.
But I guess there's this whole other bucket of insurance, and we did get some questions that related to general insurance. I've actually just moved house and don't have home and contents insurance, and I was hoping I was going to be able to ask you about that as well. But you can't give us advice on that.
Yeah, so financial advisors, we we can only advise on life insurance products. The general insurance products, it's under a different licensing arrangement. It's under a general insurance. I'll geek out a little bit more. They're under two different sets of the legislation. One's a Life Insurance Act, one's a General Insurance Act. So the general insurance, to set up a policy, you got to go through an insurance broker. The life insurance, and under the Life Insurance Act, you got to go through a financial advisor who can recommend those products. So, all professional indemnity, home and contents, all of that stuff is a general insurance product.
Okay.
And if you will let me geek out a little bit more, the difference between them, those two bits of the act, is a general insurance act can cancel the policy on you.
Oh.
So if you claim
okay.
too much on your car insurance, the insurance provider can say, we're no longer offering you cover. And that's allowable under the General Insurance Act. Under the Life Insurance Act, once you have a policy, the life insurance provider can never cancel it on you because that's a part of the act.
Yeah, wow.
So that's why people think about, if I claim on income protection, should I not because my premiums will go up? They're not allowed to do that.
Okay.
They're not allowed to cancel your income protection after a claim because that's a part of that Life Insurance Act.
Okay, that's good to know.
With the life insurance policies, are there the waiting periods that you often get in general?
So under some of the policies, so trauma has like a qualifying period. So you need to wait 3 months before you can claim on cancer.
Yeah. Okay.
So similar to a general insurance, under income protection, there is a waiting period at claim time, but there's no qualifying period like a general insurance. So as soon as you set it up, then you can claim on your income protection. You just need to wait for that general waiting period. But for life insurance, as soon as it's set up, day one, you die day two, you'll get paid out.
Okay. Nice.
Nice. Probably still not worth dying for.
Yeah, that's right.
No. We are almost at the end, but I think my big takeaways here, firstly, are
First of all, you're massively underinsured.
I'm massively underinsured. Yeah. So to put more, as we spoke offline, Ren and I have the same super setup. For some reason, I don't know how it happened, I don't have any insurances through my super fund.
User error.
Nah, I don't know. It seems like something
Depends
I
on
would,
who you're talking
It doesn't seem like something I would do. Anyway, I also don't have the ability to click a button and they will go out and put super. Before this conversation, I didn't have the ability to switch on insurance within the super fund, which also seems like a bit of a product. Anyway, they can figure that out. But it's good to know. I think my takeaway from this is that there are ways that I can keep it out of the cash flow that I currently have, but still do it through super fund, but probably in a more effective way and in a way that covers me better than the default that would come through the super fund.
Yeah, and to be perfectly blunt, every time we replace a policy, I look at that advice, and most of the time the policies through the super fund are more expensive than the same underlying insurance provider going through an advisor. And I can go really deep into that and why that's the case. But one of the reasons is, there is becoming a trend with super funds to keep the tax deduction that the members should be getting access to. So insurance within super, the tax rate within superannuation is 15%. So your insurance premiums, $1,000 premiums, the member should get $150 tax back. There's a big trend at the moment with some of the biggest super funds that are going, actually, $150.
Looking pretty good.
I'll keep it. Thank you very much.
You're more than welcome to
Name and shame.
if you want.
I mean, we've got Legal Super just made the change. Rest Super does it. They say it's to make their future premiums cheaper, and it's to administer the insurance premiums, which 15% of all premiums. I calculate. I looked at their profit and loss because I geek out about this stuff, and it's something like $300 million or something ridiculous. That they're maybe that's a bit too much. Maybe an insane amount of money. That they're just decided, hey, we will keep. Imagine your boss saying, hey, you've done your personal tax return, you got $1,000 back. I'll keep that because I pay you. It's insane, but that's what some super funds are doing. They're withholding it.
How does someone find out that with their super fund?
It is incredibly difficult to find out because they won't. They disclose it in their PDS. Like Australian super, they don't keep it. But if you're not contributing to your super fund and therefore not paying tax, then they will offset the tax that you're paying by the refund of that. So if you're not contributing but you're still paying that $1,000 premium, then they won't give you that $150 back. Australian super. It is. I went deep into PDSs, and these 120-page super PDSs that are not very fun to try and work it out. And for me, I know what I'm looking at. It's very difficult to find this info.
So I think
no one's going to find
the
it.
answer to your question is they speak to Phil. So just on that, so let's say I'm with Rest and we're just picking that because
Phil
Because
said
they,
it.
they keep the tax. They keep the tax deduction money.
if we then went to you and set up insurance that was paid through our Rest Super, could you have exactly the same insurance set up, but the only change is I actually want my tax back to me?
Yes, and it's not always going to be cheaper. 95% of the time it will be, but it's not always going to be cheaper. There are situations where it's not for whatever reason. The default cover is normally really cheap. That's the good thing about super. That default cover is the insurance companies, they tender for that and they make that dirt cheap. But the reason they do it is because when they increase it, that's not tendered.
Yeah.
And that's just a direct relationship between the insurer and the member. So that's when the insurance providers make their money back. And we've done a lot of research again on the base cost, and then when you increase it, the percentage increase is significant. So we can do that. We can set it up so your Rest or whatever super fund you're with pays the premiums. And if we tell anyone to cancel their Rest cover, which is pretty rare because there are lots of reasons why we keep it, the default cover, we'll always make a comparison and show everyone what the cost would be. Is if we increased it with Rest, it would cost you this much. If we went with the provider that we're recommending at these kind of features, this is what it would cost you. And that's what I look at every day. Every day I get three emails. I literally just look at that table and go, is it more expensive? Yes, it is more expensive to keep. Because from a business, that's the biggest risk, is replacing something that's more expensive, even if it's a better quality.
Now, one more from me, and I think then Ren has a final. But just talk us through the relationship between you and your client, because in terms of financial advice, often there's a bit of an ongoing relationship, working towards goals and those sorts of things. But when I come and see you, is it just sort of a one-off? You really help tailor what's right for me, and then what is the relationship like?
Yeah, so our process is we start off with a 15-minute phone call because we want to make sure that people only want insurance advice. We don't give holistic advice. We won't recommend asset allocation in super. We just want to make sure that people are understanding that we're only going to provide insurance-only advice. And so we'll go through the process. And so there's an initial phone call. And then we get people to fill out a massive online form. And the main thing we focus on is health questions, because that's where we tailor the insurance recommendation to the client, because that has the biggest impact on which insurer we recommend is someone's health history. And so we'll ask heaps of questions. Then we go and basically we talk to the insurers and say, hey, here's the health history. We de-identify it, and they give us an indication of what the terms would be in terms of exclusions and loadings, and we can talk about that on a future episode. And then we'll put forward an insurance proposal where we basically say, this is the expected exclusions and loadings on the policy. This is the level of cover that we recommend based on your financial position, and this is the cost of that cover. And then from there, people can go, awesome, thank you for that. And we charge a fee for that service, and that's $330 for individuals and $495 for couples. And they can take that away and do, go and increase their own policies somewhere else, or we can help them through that process. So if they do decide to engage us with the application process, then our team kind of manage that process, and then we get paid a commission from the insurance provider through that application process. And then there's ongoing reviews. We try and treat our clients like adults. Like, when your life changes, get back in touch.
Tell us.
Yeah. You got a mortgage, you're getting a mortgage, you're having kids, all of these things we want to know about. We'll tell you if we don't need to change anything, because it's fairly straightforward. We may have set it up to kind of future-proof for those things, or whatever the case may be. And then we'll just review it and update the policies on an ongoing basis with the clients.
Awesome.
So, Phil, Bryce alluded that I had a final question.
I know. He put you in there, didn't he?
It's a curly one. How many insurance policies do you have?
Well, I've got all of them.
Just the 4?
Well,
I've
got child's cover as well. So we didn't talk about that. It's for my kids. If they have cancer or they pass away, we get a lump sum payment.
Okay.
All right.
So that's the 5th policy that we look at for people with kids. I've got all of my covers and going through the process of increasing my cover at the moment. So technically they'll be 2 separate policies on the statement, but it's with the same insurer.
Yeah, okay.
Nice.
There you go. Fully insured.
Yeah.
Leading by example.
Through super or not through super?
So life and TBD is through super. Income protection, I actually just moved it outside of super for the tax deduction. And trauma, I've got, and it has to be outside.
Okay, nice.
Epic. Well, if you're like me, and I'm sure Ren as well, like we'll probably both be in touch, Phil, to sort out our own insurances. Me especially, desperately underinsured. Oh my goodness. You can head to equitymates.com/advice, and there's a form there. If you just tick Phil's name, we'll make sure that we connect you straight through to Phil and his team, and you'll be able to go through the process with him. If you have any insurance questions or even just want to review what's in your superannuation, feels like it's definitely worthwhile. So Phil, thank you so much for making the trip up to Sydney to do this. We very much appreciate it.
No worries. Thanks, guys. And if you do reach out, we've got a big team. So you may not get on the podcast. That's one thing. We do get asked, can I speak to Phil? And it's like, I'm flying up to Sydney to jump on a podcast.
If you want to speak to Phil or any of the employee advisors at Skye Wealth, then head to equitymates.com/advice.
Yeah, link will be in the show notes. But Phil, thanks for flying up and joining us today.
Awesome. Thanks, guys.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.